Did you know that a major crash in the global economy can wipe out your entire life's capital? But there's no need to panic, because history shows that where people hurt you, some smart people not only invested their money with the right strategy, but also turned this crisis into a big opportunity. In today's video, we will talk in detail about how to protect yourself from this economic situation and what steps you can take today. Part 1. The Fragility of Wealth and the Math of Recovery. Most investors are inadvertently walking toward a financial ledge, unaware that the next market downturn will likely wipe out years of their hard-earned progress. The tragedy isn't just the market drop itself. It's the predictable human response of panic selling that turns a temporary decline into a permanent loss. While the majority will walk away with less than they started with, a strategic minority, those who understand the mechanics of asymmetric loss, will actually exit the crash wealthier than they entered. To join this group, you must first acknowledge a hard truth. Compounding is incredibly powerful, but it is also remarkably fragile. Compounding is often described as the eighth wonder of the world, where your returns generate their own returns in a virtuous cycle. However, this cycle is easily interrupted by the asymmetry of losses. Consider a $10,000 investment that grows 10% for 2 consecutive years, reaching $12,100. If a 40% crash occurs in the third year, your balance doesn't just dip, it plummets to $7,260. You haven't just lost your gains, you've eaten into your principal. The mathematical trap is that to get back to your previous high of $12,100, you don't need a 40% gain, you need a 67% gain. This is why losses hurt significantly more than gains help. The danger of being out of the market during these volatile periods is backed by staggering data. A Fidelity study revealed that an investment of $10,000 in the S&P 500 from 1980 to 2022 would grow to over $1.8 million. However, if an investor panicked and missed just the 5 best trading days over those 42 years, their final total would drop to roughly $671,000. Missing the top 50 days would leave them with a mere $76,000. You take the same risks as everyone else, but by interrupting the compounding process at the wrong time, you end up with 14 times less money. The goal, therefore, is to create a system where you are never forced to sell. But how often do these wealth killers actually happen? In the next section, we'll break down the statistics of market crashes so you can stop fearing them and start expecting them. Part 2. Decoding the frequency of market chaos. To survive a crash, you must stop viewing it as a once-in-a-lifetime catastrophe and start treating it as a recurring, normal part of the economic seasons. In fact, market downturns generally fall into 3 predictable categories: corrections, bear markets, and full collapses. If you plan to be an investor for decades, you aren't just likely to see these events, you are guaranteed to experience all of them multiple times. The most frequent event is a market correction, defined as a drop of 10% or more from recent highs. These are incredibly common, occurring roughly every 1.2 years on average since 1980. Think of a correction as a healthy reset button that prevents the market from overheating after prices have run up too quickly. The second level is a bear market, which is a decline of 20% or more. Since 1932, These have arrived every 4 to 5 years and typically last about 10 months. While 10 months of declining numbers feels grueling, it's helpful to remember that bull markets, periods of growth, historically last 3 times longer than bear markets. Finally, there are market collapses, where the market sheds 30% or more of its value, often with terrifying speed. We saw this during the 2000 dot-com bubble, the 2008 financial crisis, and the 2020 pandemic onset. In the dot-com era, the Nasdaq lost nearly 80% of its value over 2 years. If you aren't mentally and financially prepared for these depths, you will succumb to the urge to stop the bleeding at the exact moment you should be holding firm. The question isn't if these drops will occur, but whether your foundation is strong enough to withstand the pressure when they do. Now that you know a crash is inevitable, what specific steps can you take today to ensure you're the one buying when everyone else is fleeing? Let's dive into the 3 pillars of a crash-proof portfolio. Part 3. The 3 pillars of financial resilience. Preparation for a market crash must happen while the sun is still shining. Once the storm hits, it is often too late to adjust your strategy. There are 3 specific, practical actions you should take right now to protect your compounding from being shattered. The first is protecting your foundation with a robust emergency fund. This isn't just a small cash cushion. It should be 3 to 6 months of full living expenses kept in a high-yield savings account. During economic downturns, crises often cluster. People don't just see their portfolios drop, they also face job losses or medical emergencies. Without a cash reserve, you are forced to sell your investments at the bottom of the market just to pay your rent. An emergency fund acts as insurance for your compounding, ensuring that you never have to liquidate your long-term assets when they are essentially on sale. The second pillar is the automation of dollar cost averaging, DCA. Instead of trying to time the perfect entry point with a lump sum, you invest a fixed amount at regular intervals, regardless of market conditions. This strategy is mathematically brilliant during a crash. When prices drop, your fixed dollar amount automatically buys more shares. For example, if you invest $200 a month and the share price drops from $20 to $10, you go from buying 10 shares to buying 20. When the market eventually recovers, your average cost per share is significantly lower, and your wealth accumulates faster than if the market had stayed flat. Automation is key here because it removes the emotional hesitation that occurs when the news is full of doom and gloom. The third pillar is true diversification. This doesn't mean owning multiple stocks in the same industry. It means spreading capital across different asset classes, sectors, and geographies. A resilient portfolio might include U.S. stock indices, international markets, bonds for stability, and perhaps real estate. This allows for rebalancing, where you sell a bit of what has performed well to buy more of what has dropped, effectively forcing you to buy low and sell high. But even the best strategy can fail if your own brain betrays you. Why do smart people make such terrible decisions during a crash? And how can you hack your biology to stay the course? Part 4. The psychology of the red screen. Investing success is rarely determined by intelligence or complex strategies. It is almost entirely determined by psychology. When you open an investment app and see your portfolio deep in the red, your brain's ancient survival mechanisms kick in. This is loss aversion, a phenomenon where the pain of losing money is twice as powerful as the joy of gaining it. Your biology screams at you to stop the bleeding and sell, which is the single most lethal mistake a long-term investor can make. The history of the Fidelity Magellan Fund provides a haunting example of this psychological trap. Under legendary manager Peter Lynch, the fund averaged a staggering 29% annual return over 13 years. Yet, the average investor in the fund actually lost money. They would jump in when the fund was hot and panic sell as soon as there was a dip. They let their emotions override the math. To avoid this fate, you cannot rely on willpower alone. You must make your decisions before the fear arrives. The most effective tool is a written investment plan. This document should explicitly state what you own, why you own it, and exactly what you will do if the market drops 20% or 40%. When the crash inevitably comes and your gut tells you to run, you pull out your written plan and remind yourself that your calm self already decided the fearful self is wrong. By committing to a predetermined path, you bridge the gap between biological impulse and financial logic. What does the data actually look like for those who hold their ground? In our final section, we'll look at real-world examples of how crashes from 2008 to the COVID era actually minted millionaires out of those who stayed the course. Part 5. Evidence of the rebound. The ultimate proof of staying invested lies in the historical data of market recoveries. Research by J.P. Morgan shows that the most explosive growth days in stock market history often occurred during or immediately following a crash. For instance, 7 of the 10 best single-day returns in the history of the S&P 500 happened during the 2008 financial crisis. If you sold during the panic to protect yourself, you didn't just lock in your losses, you missed the very days required to heal your portfolio. This is the cruel irony of panic selling. The moment of maximum pessimism is usually the moment of maximum opportunity. Let's look at the numbers from the 2008 crisis. Between 2007 and 2009, the market fell roughly 57%. An investor with $100,000 saw it shrivel to $43,000. However, those who continued to invest $500 a month during that brutal period were buying shares at a massive discount. By 2021, those discount shares had tripled in value.